Hey there, savvy investors. Have you heard whispers of exclusive investment vehicles promising sky-high returns? We're talking about hedge funds, the darlings of Wall Street, shrouded in an aura of mystery and exclusivity. These aren't your grandpa's mutual funds. Hedge funds operate in a different league, attracting seasoned investors seeking to supercharge their portfolios. But are they all they're cracked up to be? Let's dive in and find out. Intrigued? You should be. This high-stakes world promises enormous potential but comes with its own set of rules and risks. Buckle up as we demystify the world of hedge funds, exploring their inner workings, strategies, and the steps to build your own hedge fund empire. Stay tuned! Let's cut through the jargon, shall we? In the simplest terms, a hedge fund is an investment fund that pools capital from accredited investors. Think wealthy individuals and institutions. Unlike their more traditional counterparts, hedge funds aren't confined by the same rules and regulations. They have more flexibility to deploy a wider range of investment strategies, often involving complex instruments and techniques. Now, this freedom comes at a price. Hedge funds typically involve higher risks, but also hold the potential for greater returns. They're not for the faint of heart, that's for sure. But if you're looking for an investment vehicle that can zig when the market zags, hedge funds might just be your ticket to financial freedom. Okay, so how do hedge funds differ from the mutual funds you're probably more familiar with? Think of it this way. Mutual funds are like the reliable family car, while hedge funds are the sleek sports cars. Both can get you from point A to point B, but the experience is vastly different. Mutual funds pool money from many investors and invest in a diversified portfolio of stocks, bonds, or other assets. They're tightly regulated and generally considered lower risk. Hedge funds, on the other hand, employ more aggressive strategies, aiming to generate higher returns regardless of market conditions. They use leverage, short selling, and derivatives to amplify their bets, which can magnify both gains and losses. Ever wondered what goes on behind the closed doors of those swanky hedge fund offices? Let's peek inside the engine room. First off, hedge fund managers raise capital from wealthy individuals and institutions, promising them impressive returns. This money is then invested in various assets based on the fund's specific strategy. Hedge funds employ a range of sophisticated strategies, from long-short equity buying undervalued stocks and shorting overvalued ones, to global macro making bets on macroeconomic trends. They also use leverage, borrowing money to amplify their returns, and derivatives, financial instruments linked to the performance of an underlying asset. The goal is to generate positive returns regardless of market direction. But remember, higher returns come with higher risks. Section 5. Strategies for success. Navigating the investment landscape. Now let's talk strategy. Understanding the landscape is crucial for making informed decisions. Hedge funds aren't a one-size-fits-all investment. They are as diverse as the investors who choose them. They employ a variety of strategies, each with its own risk and return profile. This diversity allows for tailored approaches to meet specific investment needs. Think of it like choosing a weapon from an arsenal. Some popular strategies include, each with its own unique advantages. Long-short equity. This classic strategy involves buying undervalued stocks, going long, and selling overvalued stocks, shorting. It's a balanced approach to capitalize on market inefficiencies. It's like playing both sides of the field. You can benefit from both rising and falling markets. Market neutral. This strategy aims to minimize market risk by balancing long and short positions. It seeks to generate returns regardless of market direction. It's like walking a tightrope, seeking profits from stock mispricings. Precision and balance are key. Global macro. This strategy focuses on macroeconomic trends such as interest rates, currencies, and commodities. It takes a big picture view of the global economy. It's like being a global fortune teller, predicting and capitalizing on worldwide economic shifts. Event-driven. This strategy seeks to profit from specific events, such as mergers, acquisitions, and corporate restructurings. It thrives on corporate actions and changes. It's like being a financial detective, sniffing out opportunities. Keen insight and timely action are crucial. Each strategy comes with its own set of risks and rewards. Understanding these can help in making better investment choices. Choosing the right one depends on your investment goals, risk tolerance, and time horizon. A well-thought-out strategy aligns with your financial objectives and personal comfort with risk. Section 6. Building your hedge fund empire. A step-by-step guide. Feeling inspired? Ready to launch your own hedge fund empire? It's an exciting journey, but it requires more than just enthusiasm. Hold your horses. It's not as simple as renting a fancy office and putting up a shingle. There are many complexities involved. Building a successful hedge fund requires careful planning, expertise, and a hefty dose of grit. It's a challenging but rewarding endeavor. Here's a roadmap to get you started on this ambitious path. 1. Gain experience. First things first, you need to know your stuff. This means immersing yourself in the financial world. Gain experience in the financial industry, ideally at a hedge fund or investment bank. This hands-on experience is invaluable. Learn the tricks of the trade and build your network. Connections can open doors and provide crucial insights. 2. Develop a strategy. What's your edge? Your strategy should be unique and well thought out. Develop a unique and robust investment strategy that sets you apart from the crowd. This is your competitive advantage. 3. Create a business plan. Outline your fund's objectives, target market, fee structure, and operational plan. This document is your roadmap. This is your blueprint for success. It will guide your decisions and attract potential investors. 4. Register the fund. Navigate the regulatory maze and register your fund with the appropriate authorities. Compliance is key. This ensures you're operating within the law. Regulatory compliance protects you and your investors. 5. Raise capital. Time to put on your fundraising hat. This is where your networking skills come into play. Convince investors to entrust you with their hard-earned money by showcasing your track record and strategy. Trust is crucial. 6. Set up operations. Build a solid infrastructure, including technology, compliance, and administrative support. This ensures smooth sailing and operational efficiency. 7. Manage the fund. This is where the rubber meets the road. Your day-to-day operations will determine your success. Execute your investment strategy, manage risk, and communicate with investors. Transparency and performance are key. Building a hedge fund is a marathon, not a sprint. It requires long-term commitment and perseverance. It requires dedication, resilience, and a bit of luck. The journey is tough but can be incredibly rewarding. But with the right ingredients, you can turn your financial dreams into a reality. Success is within reach if you stay focused and determined. Section 7. The price of high returns. Understanding hedge fund fees. Now, let's talk about the elephant in the room, those hefty hedge fund fees. Hedge fund managers aren't in it for their health, folks. They command a premium for their expertise and risk-taking. The most common fee structure is the 2 and 20 model. This is an annual fee, typically around 2% of the assets under management, regardless of performance. Think of it as a rent for their expertise. This fee is charged on any profits generated above a certain benchmark, usually 20%. This incentivizes managers to deliver those outsized returns. These fees can eat into your profits, so it's crucial to understand how they work and factor them into your investment decisions. Remember, high fees don't always guarantee high returns. Section 8. Navigating the labyrinth. Risks and regulations in the hedge fund world. Investing in hedge funds isn't for the faint of heart. It requires a deep understanding of the financial landscape and a willingness to take on significant risk. It's a high-stakes game with its own set of risks and regulations. The potential for high rewards comes with equally high risks. Before you dive in headfirst, it's crucial to understand the potential pitfalls. A single misstep can lead to substantial financial losses. Hedge funds employ leverage and complex strategies, which can amplify both gains and losses. Don't bet the farm. The use of leverage can turn a small loss into a catastrophic one. Hedge funds operate in a highly regulated environment. Compliance with these regulations is not optional but mandatory. Failing to comply with regulations can result in hefty fines and reputational damage. This can severely impact the fund's ability to attract new investors. Hedge fund managers are under immense pressure to deliver consistent returns. This pressure can sometimes lead to risky decision-making. This can lead to excessive risk-taking, which might not always pay off. Investing in hedge funds often involves lockup periods, which restrict your ability to withdraw your money. These periods can last several years. Make sure you're comfortable with the terms. Understanding these restrictions is crucial before making any investment. Make sure you're comfortable with the terms. Discuss them thoroughly with your financial advisor. Hedge funds are often viewed as secretive and risky. This perception can affect their reputation and investor confidence. Maintaining a positive public image is crucial for attracting and retaining investors. Transparency and communication are key. Navigating the hedge fund world requires careful due diligence, a sound understanding of the risks involved, and a strategic approach. A sound understanding of the risks involved and a strategic approach to risk management, and a trusted financial advisor by your side. Their expertise can help you navigate this complex and often volatile investment landscape. Section 9. The two sides of the coin. Potential and challenges of hedge funds. So, are hedge funds all they're cracked up to be? Like any investment, there are two sides to the coin. Let's weigh the potential benefits against the challenges. Hedge funds have the potential to generate significant returns, outperforming traditional investments. Hedge funds can provide diversification benefits, reducing overall portfolio volatility. Investors gain access to experienced portfolio managers with specialized knowledge. The 2 and 20 fee structure can eat into profits, especially in down years. Hedge fund strategies can be complex and difficult to understand, making due diligence crucial. Hedge funds are not subject to the same disclosure requirements as mutual funds, making it harder to assess risk. Ultimately, the decision of whether or not to invest in hedge funds depends on your individual circumstances, risk tolerance, and investment goals. Section 10. Conclusion. Are hedge funds right for you? So there you have it, folks. We've journeyed through the exciting, yet often perplexing world of hedge funds. We've uncovered their inner workings, explored their strategies, and weighed their potential rewards against their inherent risks. Remember, hedge funds aren't a one-size-fits-all solution. They're sophisticated investment vehicles best suited for experienced investors seeking to diversify their portfolios and potentially enhance returns. Before diving in, it's crucial to conduct thorough due diligence, understand the fee structure, and carefully assess your risk tolerance. If you're considering venturing into the world of hedge funds, consult with a trusted financial advisor to determine if they align with your investment goals and financial situation. Remember, knowledge is power. Happy investing.